Welcome to the video series on money management in trading. In this series, I will be covering money management and risk management in great depth. In this particular part, I will be discussing one of the most important concepts in money management, that is importance of knowing risk of ruin. After finishing this part, you will have a good understanding of how not to lose your entire capital while trading. So let's get started. So this entire series about money management and risk management is structured in such a way that you can understand the importance of capital preservation while maximizing your profits. Now, many beginners who come to the stock market do not understand the importance of money management in success, and therefore I have dedicated an entire series towards this topic. So in case you are one of those traders who has lost money in the market, this is the concept which will help you understand why you have lost money till now. I've also suggested 3 solutions for you so that you can implement this in your own trading and eliminate the risk of ruin in your own trading account. Now, calculating risk of ruin is pretty simple and I have shared the formula in the video, but in case you are not familiar with Microsoft Excel, then do let me know in the comment section below and I will email the Excel sheet to you. So risk of ruin is perhaps the most important concept in trading that is not spoken about that often. This is one concept that every trader should be aware of, and yet I find very few books and tutorials mention this on a consistent basis. So this is precisely why this is the first topic I will cover in this money management in trading series. The reason why risk of ruin is so important is because it will help you understand why you have lost money till now. In simple terms, risk of ruin is a statistical measure that tells a trader the odds of losing so much money, which will eventually lead one to stop trading. Now, do note here that risk of ruin does not mean losing 100% of capital. For some of traders, it would just mean losing 50% or even 60% of capital. Now, this varies from trader to trader, and this mainly depends on risk tolerance level. Now, there are a couple of ways to calculate risk of ruin, and this is something we will cover in subsequent slides. Let me first show you one of the most effective ways to quickly determine risk of ruin and then to make necessary changes to avoid it. The formula to calculate risk of ruin is given in front of you. In this formula, W stands for winning percentage, L stands for losing percentage, and N is the units of money in trading account. So W and L are winning and losing percentage of your own trading strategy. The most simple way to determine this is to refer to historical backtest data of your own trading strategy. Now, I'll recommend for you to analyze at least 3 years of historical backtest data to determine the stats for winning percentage and losing percentage. So let me now explain what N stands for. So let us assume your account size is of 100,000 and you decide to risk 5,000 per trade. N would then be calculated as account size divided by risk per trade. So in this case, value of N would be 20. So let us now take up an example to understand risk of ruin calculation better. So in this example, I have taken a trading strategy which has winning percentage of 56% and 44% is the losing percentage. Since account size is 100,000 and risk per trade is 5,000, there are 20 units of money available for trading. Now, if you take these values and put it in this formula, risk of ruin would come about at 1%. Now, as a trader, you should aim for risk of ruin to be as close to 0 as possible. In my own experience, I found that reading above 4% does not work in the long run. So now that you have understood the basics of risk of ruin, let me now show you 3 main ways that you can aim for your own risk of ruin to be as close to 0 as possible. So the first way to avoid risk of ruin is to reduce the size of risk taken per trade. So in this chart, I have taken 6 traders who trade with the same system which has winning probability of 45% and losing probability of 55%. Now each trader, if you see, has account size of 100,000, but risk per trade is different due to their own risk profile. So trader 1, if you see, has 2 units of money available, followed by trader 2, 3, 4, 5 and 6 who have 5 units, 10 units, 15 units, 20 units and 25 units respectively. Now do remember here that unit of money is calculated by dividing the account size by risk taken per trade. Now, based on how much each trader risks per trade, trader 1 has 67% odds of losing all of his money. Trader 2 and trader 3 have 36% and 14% odds of same. Now do take a look at trader 4, 5 and 6. Each of these traders have just 5%, 2% and 1% odd of losing entire capital. So the main reason for this is that they are risking limited amount of money per trade, which in turn is helping them to preserve their capital over the long term. Now at this stage of your life, if you are someone who is repeatedly losing a lot of money, then begin by reducing risk per trade right away. See, at this stage, you have to understand that your number one priority is not to make money in the market. If you are beginning in stock market, then your number one priority has to be to always protect your capital. Now, even after having some amount of experience in market, my number one rule in trading is to always look after my capital. I'm never bothered about profits. I'm never bothered about losses. The number one priority for me when I get up each day is to protect my capital at all costs. So the second way to avoid risk of ruin is to trade a trading strategy that has high odds of success. Now in this chart, all traders that you see here have account size of 100,000 and all are risking 10,000 per trade. Now unit of money available to each trader is 10, that is account size divided by risk per trade. So based on this chart, trader 1 trades with a trading strategy that has 51% win ratio. If you look at risk of ruin for trader 1, it stands at 67%. Similarly for trader 2 with a win ratio of 53%, risk of ruin stands at 30%. Now take a look at trader 5 and trader 6. With win ratio of 60% and 65%, their odds of risk of ruin is just 1.7% and 0.2%. So as win ratio of a trading strategy improves, it is less likely for a trader to lose his capital. I hope this point is clear. Now at this stage, do compute win ratio of your own trading strategy, and in case your win ratio is less than 50%, then either shift to a strategy with high win ratio or start reducing your risks per trade so that you can sustain for a longer time in the market. So till now, you know how to calculate risk of ruin based on win-loss ratio and units of money available. So let me now show you how to calculate risk of ruin based on capital and maximum drawdown of a system till date. So do note here that maximum drawdown is the maximum loss from high to low in a portfolio, and this remains a key metric to track in risk management. The formula to calculate risk of ruin is given in front of you, where W stands for winning percentage, L stands for losing percentage, and N is defined as total capital divided by maximum drawdown till date. Now this way of calculating risk of ruin is also good, as this takes into your account your win-loss ratio along with the capital available and drawdown based on your own trading strategy. So in this example, win ratio is at 53% and loss ratio is at 47%. Total capital under consideration is 50,000 with maximum drawdown till date of 5,000. So the value of N in this case is 50,000 divided by 5,000, that is 10. Now when you put all these values in the formula given here, risk of ruin percentage comes out to be 30%. So at this stage, I hope you can see why recording all your trades is so important in stock market. Unless you get into the habit of documenting all your trades in a journal, you will never be able to compute risk of ruin metrics. The main reason for this is you will require statistics on winning percentage, losing percentage, and maximum drawdown of your own trading strategy. So my recommendation for you will be to document every trade that you take in detail. Now the third way to avoid risk of ruin is to trade a strategy that has limited drawdown. Now in this example, all traders are trading a different strategy that has win ratio of 51%, and capital for each trader is at 50,000. So trader 1 has a maximum drawdown of 5,000 till date and his risk of ruin stands at 67%. Trader 2, if you see, has maximum drawdown of 4,000 and his risk of ruin stands at 61%. Similarly for trader 3, 4 and 5, risk of ruin stands at 51%, 37%, and 14%. Now take a look at Trader 6 here. Trader 6 has a maximum drawdown of 500 and therefore his risk of ruin is at 2% only. So in this particular example, as amount of drawdown decreases, odds of risk of ruin also decreases. Now as a trader, you can have maximum drawdown of 5,000 and still lower your risk of ruin below 2%. For this to happen though, your win ratio would have to be closer to 60%. So I hope you can see how win ratio, risk per trade, and drawdown impact the risk of ruin for a system. Your aim here has to be to use a trading strategy that finds a balance between all these variables that we have discussed. This way, you will reduce your odds of risk of ruin drastically. So let me now explain how you should be proceeding forward from here. Now that you've understood the concepts of risk of ruin, you should now calculate risk of ruin for your own trading strategy. For this, you will require win-loss ratio, risk per trade, and the drawdown statistics. In case you do not have the same, I would strongly recommend for you to test at least 3 years of data. Your entire focus here should be to bring your risk of ruin below 2%. Now, once you've computed your results, in case you need feedback about the same, then do let me know in the comment section below.